walk into a bank today asking for a commercial real estate loan, they smile politely and hand you a term sheet with a 7.5% interest rate. You sigh, maybe argue a little bit, but deep down you know that's just the market. Meanwhile, across town, an institutional investor locks in a deal not even at 7. They're getting at 5.5% debt on a bigger loan with better terms. How? Because it's not just about luck, it's about relationships. It's about structuring their deals in a way that fundamentally shifts the risk for the lender. And once you understand how they're doing it, you realize the game is played completely differently at the top. So today I'm pulling back the curtain. I'll show you how institutions are securing better rates, faster approvals, and strategic advantages in the same market where most investors are getting squeezed. Now, this isn't theory. This is happening today, right now. And if you want to survive, or better yet, capitalize in the next 18 months, you need to understand these moves, because by the time it's obvious for everyone else, the best opportunities will already be gone. So let's dive in. Here's a problem most investors don't see yet. The lending market isn't fair anymore. It's fractured into two realities. On one side, you have everyday investors, brokers, syndicators, even small funds who are fighting for 7 to 8% debt, getting squeezed on terms, and being told that's just the market. On the other side, institutions are operating by a completely different playbook. They're structuring deals, negotiating terms, and aligning incentives to access rates that seem impossible to the average investor. It's not because they're celebrities. It's not because they're writing 9-figure checks. It's because they know how to package risk in a way lenders love. They're using techniques like forward rate locks, structure agency debt with credit enhancements, credit-backed note purchases, bank relationship pricing models, hybrid bridge-to-perm conversions. And when you stack these advantages, it's not just about saving a few basis points. It's about creating margin that compounds over the life of the deal. That margin means I'll compete you and still beat you on cash flow, even paying more upfront. So while you're calculating if a 7.25% loan even makes sense on paper, they're locking in 5.5% and scaling. It's brutal, it's real, and unless you understand the mechanics behind these moves, you're always going to feel like you're playing from behind. So today we fix that, because once you see what they're doing, you can start adjusting how you negotiate, structure, and even position yourself in today's lending environment. This isn't the first time the capital stack is fractured. Every major real estate cycle in the last 40 years has created two different classes of borrowers. You have the public borrowers chasing whatever the market offers, and the private players engineering custom debt that the average investor never even sees. So let's go back to the 1990s. After the savings and loan collapsed, lending institutions were paralyzed, rates shot up, capital became scarce, mom and pop investors were squeezed out of the market entirely. But institutions, they were securing private placements, assumable debt structures, and a layered financing that bypassed traditional underwriting altogether. See, that's how Sam Zell Equity Residential scaled into a national powerhouse. Not just by finding deals, but by weaponizing access to capital others couldn't even touch. And that's the same thing that happened after 2008. The great financial crisis wiped out regional banks. Retail borrowers were left begging for 7%, 8%, even 9% money if they could get it at all. Meanwhile, Blackstone and Brookfield were quietly stacking up low-interest bridge loans, mezzanine debt, and agency-backed acquisition financing at rates nobody thought was possible. They didn't wait for rates to drop. They built their own cost of capital advantage, buying while the rest of the market was frozen in fear. And today, we're watching it happen again. The public narrative says rates are too high, there's no good debt, but the institutions know better. They're bypassing the headlines, leveraging forward rate locks, negotiating relationship discounts, and structuring assumable debt stacks you'd never see on a term sheet. Because in reality, debt markets don't move evenly. They move for those who move first and move intelligently. And if you're relying on public rate sheets and chasing after 7% rate loans, you're playing a different game entirely. A slower, more expensive, less scalable one. Because history doesn't inform the future in real estate. It defines who gets to write it. And now it's clear who's picking up the pen. So right now, if you walk into a bank or check online mortgage marketplace, you're going to see something depressing. 7, 7.5, even 8% interest rates for commercial real estate deals. And that's if you have excellent credit, a strong track record, and a perfect deal profile. See, for most private investors, the terms are brutal. Lower loan-to-value ratios, higher reserves, and much stricter underwriting standards. It feels like financing is broken, but the game isn't rigged, but it feels like it. It is, because while you're being quoted 7.25% fixed rates, institutional players are quietly locking in debt at 5.25%, 5.75% right now, today. And they're not doing it with some magical lender. They're doing it by mastering the hidden channels of the debt market. So let's break it down. Assumable debt. Institutional groups are actively targeting properties with low interest assumable loans attached rather than securing new financing at today's rates. They're stepping into existing loans, often locked in at 3.5% to 5%, paying a premium on price but saving millions on debt service. It's an arbitrage play most private buyers completely miss. Relationship lending. Large institutions have relationships with regional and private banks that span decades. When a billion-dollar fund promises to bring 500+ million in deposits or deal flow over the next 2 years, guess what happens? They get preferential terms you'll never see offered to the public, forward rate locks, discounted origination fees, flexible payment structures. It's an insider economy and it rewards consistency and scale. Debt funds. Private debt funds, hungry to deploy capital, are offering high-quality sponsors, customized bridge financing at much lower rates than traditional banks. So while you're stuck trying to meet Fannie Mae's strict DSCR requirements, an institution can close a deal in 30 days with bespoke financing. Higher leverage, lower costs, faster execution. Agency lending carve-outs. Even Fannie Mae and Freddie Mac, traditionally rigid in their programs, offer special terms to select institutional borrowers, especially for mission-driven housing, sustainability initiatives, or in preferred markets. Institutions are stacking discounts through green programs, affordable set-asides, and volume discounts. Seller financing at scale. In distressed deals, some institutions are negotiating seller financing second liens stacked beneath assumable debt, allowing them to create blended interest rates around 5.5%, even when the headline market says 7%. It's sophisticated, it's aggressive, and it's absolutely happening right now. Meanwhile, private investors are stuck in their retail channel, bidding on the same deals, vying for the same overexposed pricing options, and wondering why they can't make the numbers work. But here's the truth. The capital markets haven't disappeared. They just become selective, and if you're not operating like an institution with layered debt strategies, forward-looking underwriting, and pre-built lender relationships, you're not really competing, you're spectating. If institutions are securing 5.5 debt while everyone else is choking on 7.5, the playing field is just uneven. It's a different sport entirely, and that gap costs capital. If it doesn't just make sense at closing, it compounds over the life of the asset. Every year, every month, every dollar of cash flow gets magnified. So let's talk real numbers. On a $10 million deal, a 2% difference in interest rate means over $200,000 a year in additional cash flow. Over a 5-year hold, that's $1 million in pure margin. Before you even touch operations, rent growth, or expense reductions, that margin doesn't just impact returns, it warps acquisition strategy itself. You see, institutions aren't just looking at the market the way you are. They can play higher prices, offer faster closes, outbid you, and still hit their return targets because their capital stack is fundamentally cheaper. So this lets them outcompete for deals. When a broker calls for best and final offers, an institutional buyer isn't squeezing every penny to make the numbers pencil. They already have an extra margin baked into their debt. They can move faster, close harder, and stretch pricing without sacrificing returns. They can extend hold periods. With lower debt service pressure, they can rise out downturns. A private investor at 7.5% needs rent growth today to survive. Institution at 5.5% can wait, reposition, and time the market cycle for a strategic exit. Control refinancing risk. When rates drop eventually, the institutions who secured cheaper debt today can refinance from a position of strength. The private investor underwater at 7.5%, they'll be forced to refinance just to survive, often at unfavorable terms. Scale up portfolio velocity. Because each asset cash flows better, they can leverage earlier, recapitalize faster, and acquire more properties in less time, snowballing their portfolio growth, while smaller operators struggle to maintain even 1 or 2 assets. Dominate operations. Lower debt means more flexibility in CapEx projects, rent incentives, staffing models. They can optimize for tenant experience, asset longevity, and portfolio reputation, not just cash on cash survival. So now here's where it gets even sharper. Institutions are stacking operational advantages on top of financial ones because they can forecast cash flow more accurately. They can confidently invest in centralized leasing centers, AI-driven rent pricing, regional maintenance hubs, scaled bulk purchasing for renovations. All of this lowers expenses, raises NOI, and compounds returns even further. It's a flywheel effect. Lower debt costs equals higher cash flow, equals more operational investment, equals higher asset value, equals higher financing, equals cheaper capital for next deal. And most private investors aren't even at the starting line. They're still battling to find deals that pencil in today's rates, trapped in loan applications that barely qualify, negotiating against groups who are playing an entirely different game. Strategically, this means one thing. Debt is the battlefield, not cap rates, not rent comps, not even location. In the short term, whoever controls their cost of capital controls the next decade of multifamily ownership. Because it's not about winning the bid, it's about winning the margin. Institutions aren't betting on market timing, they're engineering dominance through debt structures. And unless private investors adapt through assumable debt, relationship lending, seller financing, or fund partnerships, they'll be left in the dust. Because the market isn't kind to slow learners, the groups preparing today, building lender relationships, structuring creative offers, modeling downside scenarios with better debt assumptions, they're not just staying alive, they're setting themselves up to be the next consolidators when distress finally crests. And all the others, they'll be forced to sell at discounts to the very institutions who engineered the playing field in the first place. So what does this all mean for you? It means the old rules of investing are being rewritten. If you don't have the luxury of sitting on the sidelines anymore, if you're still trying to find deals the same way you did in 2021, you're already losing ground. If you're waiting for interest rates to go back down before you make your move, you'll miss the very opportunity that today's environment is creating. The institutions aren't praying for better rates, they're engineering around them. They're locking in advantages now, and those advantages will only grow stronger over the next 5 years. So meanwhile, smaller investors who cling to outdated assumptions will find themselves boxed out of the best deals, fighting over leftovers and overpriced, competitive submarkets. Now here's the hard truth. You don't need the Fed to lower rates to win. You don't need cap rates to magically expand. You need to play a different game. And it starts with understanding one brutal fact. Debt isn't just a financing tool anymore, it's the weapon. Lower debt cost means higher margins. Higher margins mean more flexibility. More flexibility means greater survival during downturns and more power during rebounds. So if you don't control your capital costs, someone else will control your opportunities. It's not about being smarter, it's about being better positioned. So think about it. Would you rather compete against a buyer with a 5.5% loan or be the buyer with a 5.5% loan? Would you rather pray for a miracle refinance or structure your deal today so that doesn't matter? Would you rather read about the wave of distressed sales or be the one writing the purchase agreements? Because make no mistake, a wave is coming. 800 billion in maturities is a tide that can't be held back. You can ride it or you can drown in it, but you can't ignore it. So those who prepare today by getting creative, building lender relationships, exploring assumable notes, hunting seller financing will own the next cycle. And those who wait, they'll be the ones explaining years from now why they almost bought when the market shifted. So the choice is yours. It's being made right now in real time, whether you act or not. In this market, hesitation isn't caution, it's surrender. Now here's the thing. Even with all this debt pressure, even with interest rates squeezing margins, even with operational costs exploding, institutional investors are still buying. They're not just buying anywhere, they're being surgical. They're hunting in very specific submarkets. Places most casual investors overlook, or worse, places they think are safe, but are actually sitting on a ticking time bomb. Because while most headlines focus on national trends, the real fractures are happening at the local level. Not all metros are created equal, so some of them are about to face sharp corrections. Softening rents, rising vacancies, forced sales, even as others remain remarkably resilient. So if you're investing blindly based on outdated reputation, you're putting your capital at risk. But if you understand where the fault lines are forming and why they're forming, you can reposition before the cracks become obvious to everyone else. So that's why the next video, I'm breaking down the 3 submarkets most likely to collapse by Q4 of 2025 and why some investors, the smart investors, are still buying there anyway. So it's not just about avoiding landmines, it's about setting yourself up to dominate once the dust clears. Subscribe, hit the bell, and I'll see you there. Because the game is won before it's played, and the smart money's already moving.